Hello, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. You are tuned in to On Trend. This is the show designed to keep you on the right side of the trend. Here's what we're going to talk about today. We're going to go over the sector charts and rank the sectors by the high-low percent indicators, and I'll show you how I created that chart. We'll see that oil and energy-related ETFs continue to work, strong uptrends. We'll look at the 10-year Treasury yield as it turns back up and bonds turn down and find out what the ramifications of an upturn in the 10-year yield might be. And then we'll look at a handful of stocks. So first of all, looking at ranking sectors by high-low percent, I'll just define high-low percent for you. It's the number of highs minus the number of lows divided by the total issues. And when you do it like this, you're basically taking high-low percent as a percentage of total issues, and you can compare that number across all sectors and rank the sectors by the high-low percent. And this means it's easy to find the sectors that have the most new highs as a percentage of total issues, and those would be your leading sectors. All right, this chart here shows S&P 500 high-low percent in the top window, and there you can see the bars there for when high-low percent is positive are black and red when negative. And the red line is a 10-day simple moving average, kind of averages it out. And there happen to be 10 trading days in May so far, so this 10-day average reflects the average of high-low percent for May. And you can see the value over there in the upper left-hand corner, 2.38% for the S&P 500. So anything above that is going to be showing relative strength as far as high-low percent is concerned. Anything below it's going to be showing relative weakness as far as high-low percent is concerned. And so when we scroll down on this chart and look at these sectors, we can see the high-low percent values for the 10-day moving average on the left, 16.3% for energy. It is the leader. And on the right, you can see all of these new highs that were popping up from the latter part of April into May now. So actually, that's most of April. But energy is clearly getting the lion's share of new highs as a percentage of total stocks in the sector, not as a percentage of total stocks in the market, keep in mind, because there are fewer stocks in the energy sector than there are in the technology or finance sectors. But when we look at technology, on the left, you can see high-low percent is at 9.72%. And these are ranked, by the way, by that 10-day SMA. So the strongest are at the top. And so we can see a lot of new highs coming into technology during May. So that is positive for the market. So we got two clear leaders. And then when we look at finance and industrials, we can see some possible emerging leadership. The finance sector started getting some new highs last week. You can see the 10-day moving average moved to 2.61, just above what we're seeing in the S&P 500. So that's encouraging. It needs to continue. And industrials also getting some new highs. And if we can get a little pop in new highs in industrials like we did back in September, October, that could signal that this rally really is going to get some legs. So if we scroll down a little bit further, and these are ranked by the high-low percent value, the 10-day moving average, by the way. So utilities come in next at 2.14%, but you can see nothing's really been happening in utilities since November when you had a bunch of new highs, and then it's just been above and below that zero level since. So nothing, I'm not encouraged with utilities, and I'll expand on that in a little bit. Healthcare, a bit very split sector, you know, new lows, new highs, new lows, new highs, new lows, and some new highs. So still waiting for the break there. Materials not doing so good. A few new lows over the past few weeks. Consumer discretionary not doing so good either, as I'll show in a minute. We're split between weakness in housing and a bit of a perk up in retail. And we look at consumer staples. This is the sector to avoid. Yeah, it's oversold. Yeah, it's due for a bounce, but it's in a long-term downtrend. And you can see that high-low percent is at minus 8%, by far the weakest sector as far as this is concerned, and as far as the charts are concerned. So how did I create this chart? Well, you can see here I've got the high-low percent indicators there added as an indicator. You choose price and then the symbol, and it's a dollar sign, and then HLP at the end, high-low percent, and in the middle you have the sector SPDR symbol, XLE, XLK, XLF, and I plotted it as a histogram, and in order to get it shaded out, I put the opacity at 0.5, and then I did an overlay of a simple moving average, 10, a colon, and red because I wanted them in red. And then to reorder them, I just used the reorder arrows here to put the highest ones at the top and the lowest ones at the bottom. All right, now we're going to turn to the sector SPDR charts, and we can see tech and energy leading as well on the charts. Finance is recovering. I'm watching industrials and healthcare quite closely, avoiding utilities and REITs. So our first chart here is XLK, and we had a tight uptrend here. We got some volatility, but now we just have a more volatile uptrend. And this red line here is marked at the April high there, mid-April high, and that's what I would call a benchmark high. And so if you want to compare other charts, you would see if they are above or below this April high. And those that are below are lagging, and those that are above are leading. And you can see XLK is clearly leading because it broke above that April high with the big surge last week. So given the fact that we're in a long-term uptrend, we've broken out here, I would expect a move to new highs in the coming weeks. You know, maybe we get a throwback and another opportunity, and I would watch for RSI to dip into its oversold zone for a possible pullback opportunity. The next chart here shows XLE, and I would put it as the second strongest sector, and that is simply because XLK before hit a new high in March. XLK hit a new high in January, so it has the most recent 52-week high, XLK does. But there's nothing really weak on this chart, and ExxonMobil got a big bounce this week or the past 2 weeks to help energy because it's the biggest stock. But there you can see the breakout, the flag, and the breakout. So, you know, your first support would be back at this breakout zone around 74.5, 75. That would be the throwback to try and take an opportunity to play a pullback if you get it. But right now, there's no weakness on this chart. It's one of the stronger groups out there right now. We look at consumer discretionary. Now, as I said, this one's split. Now, what's helping consumer discretionary? Well, there it is at the top. Amazon, 21.85% of the ETF. So it's the biggest stock by far, 1/5 of the ETF. But still, it's a bullish pattern. It's a triangle within an uptrend. So that's a continuation pattern, and we're breaking out. So that points to new highs in the future. We can see a downswing that was reversed. We got an upswing. There's that April high there, broke above it. So this upswing support would be marked around 101. So we don't have to reevaluate unless we get a close below 101 in consumer discretionary. Now here's the split that's happening in consumer discretionary. Retail got a really nice bounce over the last 2 days. And if we look at this chart, and what I mean by staying on trend is you kind of have to step back and look at the bigger picture and see, is this a pullback or is this part of a bigger downtrend? And what I mean is you had this big advance here, and then we had a sharp decline, but it did retrace 50% of that big advance, which is normal for a pullback. And then we got the breakout, and we got some hesitation, but we're still working our way higher since the breakout. And, you know, after you get a breakout, I don't believe in tight stops after a breakout, after the initial signal. I believe in wide stops after the initial signal. And then when you start turning a profit, then you get your tight stops to lock in that profit. I'll have more on that later on if I can do some testing on that. But here's a clear support level around 44 to watch, and I think retail is doing good. A lot of retailers are going to report earnings in the coming weeks, so it's going to be on the hot seat. But right now, it's bullish, and given that, I would expect it to challenge those January highs. So here's this flip side. Also, many home builders and housing related stocks are in the consumer discretionary sector. And this one has not performed well in May. It's just consolidated. Whereas retail has been moving higher there. You can see ITB is just wallowing near its lows and showing relative weakness. You know, it had the same setup basically as retail with the big advance and the pullback and establishing support, but it couldn't get off support. So the fact that it's showing relative weakness in May and actually since the middle part of April means I would just stay away, move on. There are other things, more other charts showing better strength to consider. So finance, now finance really came alive last week. And if you look at the big structure here, you had a massive advance, almost 30%. And then we've retraced, 50 to 62% with this big falling wedge, which is typically a corrective pattern within a bigger uptrend. And so we had what looked like a flag break, but the bigger uptrend trumped that. All right. It's like playing spades or hearts. You have a spade or you have a heart, a two of spades. Well, you can pull trump on the cards, and that's what the uptrend did. And so we had this breakdown, and then we rallied right back up, and this is a show of strength. And as we'll show in a little bit, I think the upturn in Treasury yields is beneficial for the finance sector. So I like the finance sector now that it's broken above its April high. There's that benchmark high. Now, industrials have some more work to do, but we still see a big falling wedge pattern. And keep in mind, this is after like a 47% advance from November 2016 to January 2018. So yeah, this is a downtrend in 2018, no doubt about it, lower lows and lower highs. And there's that April high. So that's the high you need to exceed to start getting this downtrend reversed. Looking at healthcare, now I probably should have put healthcare ahead of industrials because healthcare is challenging that April high. Again, a breakdown, but look at that, right back up and negated that support break. So you have a failed signal. You had a wedge break that didn't hold, and a failed signal tells you that there's strength out there. And if we can get a follow-through breakout at 84, that would reverse this downtrend that we had here in 2018. Looking at materials, another wedge. Got a lot of wedges out there. But there's that April high. Haven't broken above it. We did get a little mini break out there last week. And we need to get a follow-through breakout above that April high to reverse the bigger falling wedge. Here are utilities, XLU. And I don't like this chart because there's the breakdown. There's the 52-week low. And I think this is a counter trend rally. And you can see you got a classic broken support turning into resistance, and you're turning down here. So I think utilities are headed lower. Looking at REITs, I don't like REITs either, as I'll show when I get to Treasury yields. But there's that big breakdown. Again, a rising wedge, which is typically a bearish continuation pattern. And you can see we're hitting that 50 to 62% retracement zone, broken support turning into resistance. Had a little pop and drop. So I would be avoiding REITs at this stage. Now, one group that still looks strong would be energy. All right, we'll look at Brent, WTI, and gasoline, as well as some of the energy ETFs. And, really, you don't need much on these charts to figure out what's going on. This is an uptrend. All right. And in an uptrend, I don't know how far it will go. I don't know how long it will extend. I do know that I'm not going to try and pick a top, but I would be more inclined to say pick a bottom on a pullback. All right. You can see here's the first pullback that was decent because RSI got oversold there in February, but now we're back up at new highs. And we had a little bit of a flag there and broke out. So the fact that WTI is near a 52-week high is positive for the energy sector, no doubt. Here's Brent. It's even stronger. Brent surged to a new 52-week high yesterday. Look at that move. you had this kind of consolidation in February, March, and then the breakout, you know, a little pullback, breakout, little pullback, breakout, little pullback, breakout. So this is a clear long-term uptrend, and that's what you need to know right now is you got to have a bullish bias on energy. And here's gasoline, 52-week high. So all things are pointed in the right direction for energy and energy-related stocks. And so I showed XLE earlier. Here are 4 energy-related ETFs. These are industry group ETFs. We've got the oil and gas equipment and services breaking out. And then after that surge there, formed a flat flag and broke out, and that breakout is holding. Sure, it stalled for 4 days, but it's entitled to a stall after that big move up. We can see a similar pattern happening here in XOP, the oil and gas exploration and production, SPDR. We can see a breakout even in the natural gas ETF, which is the weaker one of the 3, I would think, or 4. And we're even getting a breakout there in MLPs. Pointed out this breakout in Arch charts a couple times. And now we got a little surge yesterday with a pretty big move in the MLPs. So we also have an interesting dynamic happening in Treasury yields because they have turned up and the 10-year yield is on the verge of a multi-year high. We've got banks showing a strong positive correlation, utilities and REITs showing a strong negative correlation. So first here we have the unadjusted IEF and the unadjusted TLT. That means I did not put in the distributions. This is a very raw price chart. And you can do that by putting an underscore, as you see at the top left, before the symbol. And that will show it unadjusted. But you can see here, there's the breakdown. And we had this little bounce. It's not a perfect rising flag. But, you know, after this sharp decline, you're oversold and you're entitled to a relief rally, if you will. And we broke down here, so it looks like we're poised to continue to new lows. And then if you look at TLT, a massive head and shoulders pattern. Break, and look at this is classic. The support zone turns into the resistance zone, and you failed just below it and broke down. And now we've got a little triangle working here. And if we break down again below 117 and change, then that argues for a continuation to new lows. And so if bonds move to new lows, that means Treasury yields are going to move higher because, of course, they move in opposite directions. So here's a 10-year Treasury yield, and it's got a flag there, kind of, and a breakout. And it looks like it's ready to go above 3%. And by the way, 30 on the TNX chart is equivalent to 3%. I use TNX, you can see the symbol there, because it is updated during the day. And then we have the 30-year Treasury yield. There's the breakout, a little throwback to the breakout zone, firming. So I would expect this one to bounce. That means I would expect TLT to move lower. So now I'm going to move to this next section on working with the correlation coefficient, and we'll see how yields correlate with other symbols. So I've got a chart here with the 10-year Treasury yield in the top window, and you see I've got a different symbol, $UST10Y. So that's the actual 10-year Treasury yield. And this is a weekly chart going back to the middle of 2011. And we can see that there's been basically a 6+ year range for the 10-year Treasury yield between roughly 1.5 and 3 on the high. There you can see a high there at the end of 2013. So the 10-year Treasury yield has been flat for basically 6 years. But we can see that after declining here in 14, 15, and 16, we had that breakout, the pullback, the breakout there at the end of 2017, and now we're poised to break out of what could be a 6-year range. So this is a theme going forward. We are moving into a rising Treasury yield environment, or we're in it right now, and we have to consider that when we're looking at different trades or investments. And so what I did was I set up the correlation coefficient, in other words, to understand how the 10-year Treasury yield is correlated with other symbols. We'll look at some sectors, some industry groups, and some asset classes. And the way I did that was I went down to the bottom here, and you can see I've added my indicators. Correlation is the indicator. I put the symbol, so my main symbol is the 10-year Treasury yield, and I want to compare the correlation with XLF, and I chose 13 weeks. That's a quarter. All right. And then I added an overlay of an exponential moving average, 13 weeks as well, just to kind of smooth things out. And I colored it green because it's a positive correlation. You can choose what you want to do with that. And then I just added more and separated them with the date time axis because I just like to have that separation on the chart. And so you can see as a result up here, we have our correlations. And XLF has a very strong positive correlation to the 10-year. So if the 10-year is going to be moving higher, that's going to be a positive influence for the finance sector. Now, is it guaranteed that the finance sector is going to rise? No. At the end of the day, you always have to go back and look at the actual chart of the underlying. All right. The derivatives of price, which would be anything that is not price. So when you have the price chart of XLF, that's the purest form of analysis. And then you have a moving average. That's a first derivative because you've taken a smoothing of a number of periods. You also have price relatives, and that's like a double derivative because you're dividing XLF by another symbol, say SPY, to get a relative performance. All right. Correlation is also kind of like that double derivative thing. It's quite removed from the price. So it just kind of gives you an idea of the relationship when you use the correlation coefficient. But we can see the equal weight finance sector also has a strong positive correlation. Sure, there are dips into negative territory when correlation becomes negative, but for the most part, it is positive. We look at regional banks, I think it is even stronger, the positive correlation. That's why regional banks continue to be one of my preferred industry groups at this point. Same for broker-dealers. Now keep in mind, Goldman Sachs is the biggest component of IAI, and it is suffering. It is not performing well. So it needs to perk up its performance to help IAI. But the individual discount brokers like Schwab and TD Ameritrade are doing great. And insurance has a positive correlation. So the next group I have up here would be in symbols that are negatively correlated for the most part. And you can see utilities. Now, sure, they were positive a little bit in 11 and 12 and beginning of 13. But, since then, there's been a pretty strong negative correlation between utilities and Treasury yields. That means if Treasury yields rise, utilities could come under pressure. Same thing is true with staples since 2013 and with REITs. And that's why REITs are not a favored group for me right now. And telecom is a bit more mixed than the other three, but it's maybe a little bit more negative. I don't think there's enough to go on here as far as telecom is concerned. And then if we look at some asset classes here, we've got West Texas Intermediate. So typically when Treasury yields rise, so does oil. So that's a positive influence. We can see copper is a little bit more erratic. It's got more dips and deeper dips into negative territory, but maybe it's slightly positive. Gold is mostly negative, especially since, say, 2014, maybe since 2015. Negatively correlated with Treasury yields. There, it went positive in the first quarter of this year, but now it's back negative. So gold may come under pressure if Treasury yields continue to rise. The dollar is mixed. It's negative the first couple of years here, positive for a year, negative for a year or two, positive. So I really don't know what the correlation is with the dollar because it's pretty off and on. So now I've got a few stocks to show you, and with everything that I'm presenting here, there is a concept behind it, a concept that has been put forth in technical analysis in some way, shape, or form. And that's what we need to learn, is we need to look at these charts and figure out what's the concept behind what I'm seeing here. And so I'll point out a few of these concepts in the next few charts on these individual stocks. And the first one we have is Tesla. The concept here is the return to the support break. So if we look at Tesla here, we can see a number of negative things on this chart. First is a major support zone there, and it is broken with a sharp decline. All right, now we've got a rally back to the broken support zone. And the concept here is that broken support turns into resistance. And we could probably put on some Fibonacci retracements from that March high to that April low. We'll probably got a 50% retracement around there. And you can see we're hitting resistance. We can see the 50-day EMAs are below the 200-day. 200-day is sloping down here, and prices are below it. So I would expect Tesla to move lower from here. And then if you look at Tesla relative to the market, SPY, it was doing okay until October. And it has just been a constant underperformer relative to the market. Tesla's down 10% over the past year, and SPY is up 16%. So Tesla is not even a stock you want to consider right now. Now, the next to the concept here is a consolidation within an uptrend. And we consider a consolidation to be a rest, a continuation pattern within an uptrend. So we have Nike moving sharply higher. Then we have equal highs and some rising lows to make an ascending triangle. And it looks like we got a little breakout within that ascending triangle, and a further breakout at 70 would be bullish and confirm that pattern. The next is Danaher, which is a big industrial conglomerate type stock. And again, we have a triangle consolidation within a bigger uptrend. And there's the downswing within that triangle, and we broke it with a 3-day advance. So I would expect Danaher to hit new highs in the coming days or weeks. The concept here is you've got some relative strength going and kind of a pullback and a rounding bottom. The relative strength comes from, look at this move from August and a new high in January. You came down hard in February, but you held that low in March and started working your way higher. And now we've got a breakout above the February, April highs here in late April there. Nice little breakout, little throwback, and now we're turning back up. So I think Ross Stores is heading back towards a new high. United Health, now these two are breakouts. We can see there's the triangle within the uptrend, and there's the breakout. And then we got a throwback. You can see that resistance zone turning into support, and now we're surging off that newfound support level, and I would expect new highs out of United Health. And next we have Stryker, which is in the medical devices group, which is one of the strongest groups right now. Check out the IHI, a triangle within an uptrend. You got the breakout, a little throwback to the breakout zone, but I would expect support to hold here and this one to continue higher. And that concludes today's edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend.